Imagine a single man whose quiet decisions shook global markets, whose influence rivaled presidents, and whose policies sparked the biggest financial bubbles in U.S. history. Alan Greenspan, the Federal Reserve's longest-serving chairman, wasn't just managing interest rates, he was engineering America's economic future, one controversial choice at a time. Was he the brilliant maestro who drove unprecedented growth, or the hidden architect of inevitable collapse? Dive into the untold story of the man behind decades of U.S. monetary policy, where every calculated risk came with a price. A legacy built on tightrope walking. Alan Greenspan's tenure as the Federal Reserve Chairman from 1987 to 2006 is marked by critical junctures that profoundly shaped the U.S. economy. Known for his adept handling of market crashes and recessions, Greenspan steered the economy through the 1987 stock market crash, the dot-com bubble of the early 2000s, and the aftermath of the September 11 attacks. Many regard him as a masterful policymaker or the maestro who brought unprecedented stability during times of crisis. However, his legacy is mixed. While his policies helped the U.S. economy achieve growth, they also contributed to long-term vulnerabilities. For example, his emphasis on keeping interest rates low for extended periods arguably fostered economic conditions that led to risky market behaviors, which became evident in the 2008 financial crisis. By consistently prioritizing growth and stability, Greenspan may have inadvertently encouraged excessive borrowing and overvaluation of assets, which critics argue led to significant market bubbles. The Greenspan put, friend or foe? The Greenspan put refers to Greenspan's approach of lowering interest rates to buoy the economy during downturns, indirectly assuring investors that the Fed would step in to mitigate losses. This strategy arguably created a moral hazard, fostering investor confidence in high-risk ventures, knowing that monetary policy might protect them from severe losses. Greenspan's decision to lower rates after the 1987 crash, again during the early 2000s dot-com bust, and following 9/11 was intended to stabilize the economy and prevent prolonged recessions. However, while this provided temporary relief, it also set a precedent where investors took greater risks, anticipating Fed intervention in downturns. This assurance of support became problematic as it encouraged behaviors that contributed to speculative bubbles, particularly in housing and mortgage-backed securities, which ultimately played a significant role in the 2008 financial crisis. Handling the dot-com bubble and 9/11. The dot-com bubble of the late 1990s presented Greenspan with a challenging scenario. Stock prices for technology firms soared irrationally, inflating a massive market bubble that burst in early 2000. Greenspan responded with aggressive rate cuts, slashing interest rates to combat the impending economic downturn. His strategy proved useful in temporarily alleviating the recession, but it fueled unsustainable price rises in other sectors, notably in real estate. Following the September 11 attacks in 2001, Greenspan once again opted for extreme rate cuts, reducing interest rates to historically low levels to stabilize an economy hit by uncertainty. While these actions kept the economy afloat, they also spurred reckless lending and borrowing. The ease of credit fueled a housing bubble that, once it burst, revealed the depths of market instability and financial mismanagement in the U.S. The Great Moderation, Greenspan's golden age. The Great Moderation, from the mid-1980s to early 2000s, is a period attributed to Greenspan's successful monetary policy. During these years, the U.S. enjoyed stable growth, low inflation, and increased financial resilience, earning Greenspan significant praise for fostering stability. His policies appeared to anchor inflation expectations while promoting growth, leading many to believe he had found the ideal balance. However, some economists argue that the illusion of stability hid underlying vulnerabilities, as the low interest rates and reliance on debt-led growth became problematic. Greenspan's policies, though effective in the short term, may have led to deeper structural issues, such as rising income inequality and an economy overly reliant on credit. This moderation of volatility was short-lived, as the 2008 financial crisis exposed the fragility of the system built under his watch. Greenspan versus Volcker, a hawkish transformation. Greenspan's economic policy was shaped significantly by his predecessor, Paul Volcker, known for his unyielding stance on inflation, which hovered at 4% when Greenspan took over. Volcker's hawkish policies set the stage for Greenspan, who initially continued the anti-inflationary approach by keeping interest rates high. However, Greenspan quickly diverged from this path, adapting a more accommodative policy to support economic growth. His willingness to lower rates in response to economic pressures marked a shift in the Fed's approach, one that emphasized growth over strict inflation control. This shift became more pronounced over time as Greenspan's Fed pursued lower inflation rates to stimulate economic activity. While this led to a flourishing economy, it also left the system vulnerable to inflationary pressures, particularly during periods of high market volatility. Global impact. A U.S. Fed leader influencing the world. Greenspan's policies had a global reach, impacting economies far beyond U.S. borders. His approach to interest rates influenced dollar-based debt, particularly in emerging markets that borrowed heavily in dollars. When the Fed reduced rates, it created favorable conditions for foreign investors, making dollar-denominated debt cheaper and more accessible. However, this interconnectedness also posed challenges. Foreign economies became highly susceptible to Fed decisions, which could destabilize them if rates suddenly shifted. Emerging markets, which often rely on dollar-denominated debt, found themselves at the mercy of U.S. rate adjustments, complicating their economic stability. By indirectly impacting global economic cycles, Greenspan's legacy is one of both financial integration and heightened vulnerability, especially for countries heavily dependent on the dollar. Critics' lens. A crisis in the making? Greenspan's policies have faced intense criticism, particularly regarding his reluctance to implement stricter regulation in financial markets. Critics argue that his laissez-faire approach fostered an environment ripe for excessive risk-taking, especially in the housing sector. By prioritizing market freedom and maintaining low interest rates, Greenspan contributed to a speculative boom in real estate and mortgage-backed securities. His decision not to tighten regulatory standards is viewed by many as a factor that led to the 2008 financial collapse. Greenspan defended his actions, claiming that monetary policy alone couldn't address market bubbles. However, critics maintain that a more proactive stance could have softened the blow, illustrating the lasting implications of his choices on financial stability. Post-Fed life. Greenspan's reflections and advisory role. After stepping down in 2006, Greenspan founded Greenspan Associates, a consulting firm that advises on economic matters, and continued his involvement in financial circles. His memoir, The Age of Turbulence, offers a detailed look into his experiences and rationale behind key decisions, including his evolving thoughts on economic policy and crisis management. Greenspan's continued influence in the financial world has been met with both respect and scrutiny, as his ideas remain relevant in contemporary discussions on monetary policy. His post-Fed career allows him to reflect on and defend his tenure, yet he remains a polarizing figure whose legacy invites ongoing debate. Greenspan's reflections offer unique insights into the mind of a central banker navigating crisis, as he reaffirms the complexity of managing economic stability. Greenspan's philosophical shift, from hawk to dove. Greenspan's economic philosophy evolved significantly over his tenure. Initially known for a hawkish stance on inflation, he gradually adopted a more flexible approach that prioritized economic stability over strict inflation controls. This shift mirrored the changing economic environment as the Fed's focus transitioned to supporting growth and employment. Greenspan's later years at the Fed reveal a chairman willing to adapt his approach, reducing rates to sustain growth even when risks of inflation loomed. This transformation underscored the need for flexibility in monetary policy, but also sparked debates on whether his choices prioritized short-term growth at the expense of long-term stability. Critics argue that this shift contributed to unsustainable growth patterns that became evident in the financial crisis that followed. The verdict: hero, villain, or both? The debate around Greenspan's legacy reflects his complex impact on U.S. monetary policy and economic stability. Supporters argue that he effectively led the economy through several crises, minimizing recessions and fostering economic growth. However, detractors blame his policies for sowing the seeds of the 2008 financial crisis. citing his tolerance for market exuberance and reluctance to enforce stricter regulations. His era reflects both the triumphs and perils of modern monetary policy, highlighting the challenges of balancing short-term economic gains with long-term stability. Greenspan's influence remains integral to contemporary monetary discussions, illustrating the complexities faced by central bankers in a globalized, interconnected economy. Today, his legacy serves as a cautionary tale for the fine line between stability and risk in central banking. Thanks for joining us on this deep dive into the fascinating world of Alan Greenspan and the lasting impact of his decisions on U.S. monetary policy. If you found this video as intriguing as we did, don't forget to give us a thumbs up and hit that subscribe button. Ring the bell icon so you never miss an update. More exciting content is just around the corner.